Hi, everyone. I'm Rick Bensignor, and welcome to the In the Know Trader Show. It's good to be back after a few weeks off, and last week we actually had, if I'm not mistaken, a major snowstorm in Seattle, where this gets all produced by StockCharts, so they weren't able to get into the office that day. So it's really been since, I think, the middle of December or so since we've had a show. So lots to catch up on and do. And let's start off. We'll take a look at the agenda here. First things first is in a few weeks from now, I will be in Orlando at the Money Show. I will be speaking Saturday, February 8th at 8 o'clock in the morning. So I kind of kick things off that day to start. There's a link here if you're interested in signing up and finding more about it. And by the way, everyone should know this is a free 3-day conference for people who trade the markets or are interested in the markets. There are over 75 different speakers. The money shows and their sister programs, Traders Expos, are all run out of the same parent company. They're always free, and great way to not only meet people, but learn from some experts in the field. So it's inthenowtrader.orlandomoneyshow.com. Take a look at that and to find out more information. Certainly, if you're going to be in Florida on vacation in February, or you live in the Orlando area or anywhere that's a drive from it, I highly recommend you check it out. So that's that, and that is kind of the next public appearance that I can think of. Just last week I was on Bloomberg TV, so that has come and gone. That discussion about platinum, which is I had talked about platinum last week, potentially breaking out from the downtrend line from all-time highs, and it's just a touch above right now. Platinum's trading about 1,010. So that's something to, if you want to take a look at the clip, you can find that if you just Google or go to Bloomberg.com and put my last name, Bensignor, in, and you will be able to see any of the interviews I've done. For the balance of the show, we're going to do what we often do. We're going to take a look at macro sector relative performance. Being that it's the beginning of the year, we're just going to kind of look at where things are year to date as compared to comparing week over week. We'll take a look at the S&P and what's going on with that. We will talk about the energy complex today. Is the bottom in, or is this still a bust and heading lower? So we'll look at, I think we've got 4 charts lined up for the day to take a look at that. And then we'll also talk about a brand new newsletter that is coming this quarter that you will able to see, and we'll talk about, and I will describe and give you some information about that. So in order to contact me, it's Rick at inthenowtrader.com. Our website is inthenowtrader.com, filled with lots of videos, clips, and of course, information on how you can sign up to be an In the Know Trader client. We put out a tactical trader report every Wednesday night. In it, we discuss the macro picture of what's going on in the world and the markets. We focus on the S&P. And then each week I put out a new ETF recommendation, as well as update every open trade idea that we still have. So as long as it's either a recommendation that hasn't gotten filled as far as entry, or we've already gotten into a trade, I'm always going to walk you through everything from start to finish until the trade is closed out. And that is what the Tactical Trader Report is. Again, more information you can find on that at inthenowtrader.com. Okay, so as we take a look at results of the 11 macro sectors versus the S&P year to date, we're using the flat line here as the performance of the S&P, so everything is relative to it. The S&P itself is actually up a little over 3% this year. but we've switched the setting here such that by clicking on the stock chart of the spiders, that sets this to the benchmark for everything else. So we can see how everything is performing relative to the S&P this year. And by the way, we switched this to spiders instead of the actual S&P cash because by looking at all these ETFs that are XLY and XLC, et cetera, those all include dividends, whereas the cash S&P doesn't. So in order to make them really apples to apples, we've switched what was dollar string SPX to SPY in the stock charts perf chart setting in order so that we can look at everything again in an apples to apples way. And what I've done here with these kind of teal colored dots is highlighted those sectors that just 3 weeks into the trading year are already more than 2% differential than the S&P. So either outperformed by more than 2% or underperforming by more than 2%, because that gives you a sense right away, the beginning of the year, how institutions are positioning themselves. They often start the year with major reallocations and portfolio shifts, and this gives you a clue to what they're thinking. So what are some common things we've seen from before? Well, last year, energy was the worst performing sector, and already it's trailing by over 4.5% this year. So it continues to be the worst performing sector, not just short term, but long term. And that's what we're going to look at later in the show. Notice that materials are down about 3.6% relative to the S&P. Financials, which everybody claimed to love and think that they were breaking out to the upside, are actually underperforming by 2.3%. So that's been a disappointment to I think a lot of portfolios. And I don't know if they're shifting yet, but I can tell you that the fact that they are underperforming this early in the year, and in fact, even today, there's a noticeable kind of risk off in the markets across most markets except the bond market, which is up considerably today, and yields have fallen. The 10-year U.S. yields have fallen about 6 basis points down to under 1.78%. So you kind of have a day that stocks are off, gold is off, oil's off, copper's off big. It's down almost 5 cents. That's 1.75%. Silver's down 1.5% or so. Platinum's down 1.5%. So you're seeing a whole bunch of markets that had rallied last year coming off at least today. And whether or not there was a news event, I don't think it's so much that, but you're seeing early in the year here essentially how PMs are thinking about things, and the positives here remain. So technology, best performer last year, best performer this year, right? So these are, technology is driven by the large cap tech stocks, the Apples, the Googles, the Amazons, NVIDIA, Netflix. Now, some of those are in communication services, which is why these are also doing well. So, I like to look at this on a weekly basis just to kind of see what's changing, what's happening. And as we progress into February, we'll switch back to looking at week versus week to see what's happened, on a weekly basis where the shifts are happening. But this is always an important chart to look at to get a sense of where you may want to invest, where you want to stay away from. And in the case of something like energy, and we'll take a look, is this just going to remain a disaster, or are there any reasons or possibilities for why things can shift going forward? So that's that. Now let's take a look at some of the charts that we do. So we'll start off with the S&P, and here is a weekly chart of the S&P 500, and I've got this fairly clear channel line that it's trading back and forth within, although only 2 points on the downside that make the trend line, but multiple hits across here in the spring and summer of last year. But most important to me is this level right here, which is 33.36. This has been a long-standing upside target for us. It first got picked back in June of last year when we sold off and bottomed as we did this first week of June. Here you can see this big open candle. When that occurred, the DeMark propulsion signal got established and said that if you properly broke through 28.80 on the upside, you would get to 30.38, which you can see we stalled against there. And then it finally went through that and said, ultimately, if you get through that, 33.36 is the next upside target. And to me, I told institutional clients in my piece last night, normally it's a Sunday night piece, but because of the Martin Luther King holiday, it came out last night, that I am not chasing after stocks here. If you want to buy beaten down names, that's a different story. But right here, right now, I think we're close enough to an important upside target that there's no reason to be putting new long exposure on. And in fact, we had actually trimmed a little bit last week. So last week's high was 33.30. It's only 6 S&P points away from a long-standing target. So you can see, to start this week where you are under a little pressure, it's nothing significant as we record right now. Let me see, the S&P is only down 2 points. So it's actually come back from lows that were beneath there. But this to me is potentially an important target that, at least for now, I suspect we can see some type of back-end filling occur rather than this continuous upside that hasn't had a pause. If you look since we bottomed in September, there's just been massive strength. So after the summertime last year, where you had the sequential 13 signal, the pullback, and the back and forth over the summer, we've been basically in a straight moonshot since September. I suspect we pause here and do some back-end filling, that it's not going to just plow through here as if this level is meaningless. In addition to that, when we look at the actual daily chart, by chance, late last week, there was a sequential 13 signal, again, suggesting potential upside exhaustion to the trend. Generally, again, this model developed by Tom DeMark some almost over 40 years ago, and used heavily by the institutional community, would suggest that in a strong uptrend like we're seeing, this is not a time or place that you generally want to be buying. In other words, there's high risk to buying here. The risk reward to buying at this point in the trend is not very high. Now, the last time we had a signal, you can see that we went a little down, we went a little up, then went down, and then eventually went up. So again, it suggests, and this is something that people need to understand about any model that is looking for trend change, is that if a market's been moving higher and then it goes sideways, let's put this in the time frame of a daily chart. If a daily chart is moving higher and then you go sideways for a few weeks, then the signal that would have suggested that you weren't going higher, or at least that it's a bad time to put on new long exposure, that's a correct signal. That's actually a correct signal, because for almost a month you went nowhere. Then the trend reinitiated itself. So this implied at the time that you have higher than normal risk to first buying. You go back to the 13 signal in July of last year, same thing. It suggested that buying there produced much higher than normal risk. And sure enough, we had a sell-off from it. Now, the sell-off was quick and lasted for several months. And if you think about kind of how long it took to get above there, it was not until really late October and the surge that had just started in September that really, kicked in and produced the next move higher. So we look at these not certainly as a tell-all end-all, but certainly as a potential alarm for why not to play the trend in the direction of the trend at that point in time. So the daily 13 sequential signal coming in last week within very close striking distance of this 33-36 level, to me suggests that we're going to spend some time here, possibly back and fill. First support level, based on, let's say, DeMark indicators, I'd say right now it's at 32.74 or so. That's 50 S&P points down in percentage terms. That's not even 2%. It's about 1.5%. So it's not a big potential pullback, at least for starters. If that level kicks in, then it would say that we could get down to 32.70, and that would be a little over 100 S&P points. So that's closer to 3% downside. Again, in the scheme of things, even 3% is nothing. Most people don't care until the market moves 10%, as even seeing, what the technical community has called a correction versus 20%, which they have picked as a change in trend. I don't go by any of those because I think it's meaningless to just assign some random number, and they truly are random. They happen to be nice big round numbers, but I just don't think in terms of textbook definitions of corrections and bull markets, because they are completely unsubstantiated. There was a decline, I think it was the early part of last year, that was 19.8% in the S&P, and from peak to trough, and it didn't hit 20%, so it's not a bear market. All these different silly things that people do, trying to identify and say this is the holy grail of trading is based on this and that. I just don't go through it, and I'll tell you, I am doing this now. Let's see, I am in June of this year, I will start my 40th year in this industry. So I'm in year number 39. And I can tell you from that many years of experience in a very professional and high positioned way of looking at the market, from all the roles I've had on Wall Street, from trading in the pit for 12 years to chief market strategist at Morgan Stanley and several other firms, to running my own consulting firm for many years. Don't get stuck on labels and stuff. Look at what markets tell you, put your data together, and make your own conclusions. And the only reason that I look at what other people say is because I generally assume they're wrong. So I like to see what other people say, because I'll often fade the collective thought of what is going on in the marketplace. So again, just to finish up this portion on the S&P, sequential 13 signal from last week. We're very close to the 33-36 target level that we've had in place for months. I am not buying new names up here. So anything that's been on a tear recently, I am not touching up here. I will wait for a pullback. And the only thing I may go after are some beaten down names. And the beaten down names really kind of is a good segue into, let's take a look at the energy sector. So the first chart I want to look at is a long-term chart of the XLE, which is the Spider Energy, the S&P 500 Energy Index divided by the S&P itself. And you can see that at current price here, we are virtually on all-time lows. Now, that's because the ETFs didn't start until 1998. So I don't know what the energy sector is, and had been before in relative terms. But if I simply look at the XLE divided by spiders, we go back, fair to say 20 years. And this has been a disaster since 2008. There was an up year in 2010. Looks like 2016 was an up year, but by and large, 8 out of the last 10 years, energy has underperformed, and it looks headed to essentially go and potentially touch, if not make, new all-time lows. So this is not a healthy looking chart by any stretch of the imagination, and this is why you see so many people underweight energy. Now, we started fishing a little bit in energy in the fall of last year, and we've done okay on it because we've traded it well. For in-the-know trader clients, we got in and out of XLE, made just a little bit of money over, I think, a 2-month span. So we traded around the position and barely made anything. Certainly, we would have been much better off if we had just been in the spiders or different sector at the time. But we did some bond fishing in XLE, and at least didn't get hurt as the relative performance continued to fall down. But we were able to make a little money. So when you take a look at this chart, it gives you a very good sense of hold on one sec. I need to find my mouse. There we go. Now, let's take a look at XOP, the oil and gas index. And this is XOP versus XLE. So this is within the energy space, oil and gas names versus the whole energy sector. And you can see this too has been, long-term problematic. It certainly broke down in 2014. It hasn't recovered. Now it has had some positive years. So again, in 2016, you had an outperformance of XOP. Last year, 2018, no underperformance. 2019, bad underperformance. So oil and gas names, and this is one of the major ETFs people play within XLE is XOP. It's probably, in fact, I would say it's the most popular ETF traded next to XLE itself that is in the energy space. As far as playing individual names. Certainly USO, which tracks the price of oil, is heavily traded every day, but that is simply the price of oil. These are actual energy stocks. So if we blow this up, you can see that we're essentially darn close to testing the lows made in November. And those lows made in November is actually, I played on the institutional side, and we sold, I'll show you the XOP chart coming up so you can see. So look, you've got a downside exhaustion signal here. It's lasted for months. It's gone down, it's gone up, it's down again. We'll see if this crashes through and by how much. But that was at least the reason why I started doing a little probing into the energy and the XOP space. But again, looking at the big picture here, this even shows you that the oil and gas names continue to be a problem. Now let's look at XOP versus the S&P. Wait a minute, is that the one? That's the one we were on. Sorry. What am I missing? Here we go. XOP versus XLE. This was we hadn't looked at this. This is XOP versus XLE. Sorry about that. So the last one was versus the spiders. This is versus the energy sector itself. Obviously, long-term bad. But you can see XOP has had, bouts of outperformance along the way, including the big spike up that we saw fourth quarter. Clearly, we're getting a pullback now. Question is whether or not this kind of relative low that we saw in fourth quarter 2019 holds or not. The last piece here that I want to look at is just simply the XOP chart itself. And so here's a downside exhaustion signal. These dots are where the downside exhaustion signal, if properly breached this line at 20.60, would say that looking for this 13 to have meaning is essentially erased. And even though you had this minor close beneath it, it was not qualified. So according to the rules, you'd still be in this. So what we did is we bought the XOP in late November, early December, actually put on a double size position here for institutional clients. We kicked half out in and around 24, and now we still have half left. So I've got a free trade on in the sense that no matter what, I'm going to make money because I'll just stop myself out now on new lows. And the question is this building a base? And when I look at XOP on its own, not relative to anything else, but just on its own, it gives me a sense that there still is the possibility here that you've got, like, let's call it one group of lows here. They're multi-weeks, but here, here, here. So 3 times we've kind of built the base here. So this is going to be really important if we come down. It's not too often that you see a market get tested 4 times. And if it is, it tends to lose its meaning as far as being support or resistance, in this case, potential support. So I'm going to pay real close attention over coming weeks, whether or not we get down here or not. Um, Again, worst comes to worst, all I do is sell the other half out at where we got in. That's the scratch trade. The rest we made about three and a half, I think about $3.50 on. So that was about, I don't know, 15%, something like that. But looking at it just now, um, let's see, let's see if we can get that. There we go. That to disappear. And let's take a look at it also on a daily chart. So this is the other thing that's important, is the daily chart corroborates what the weekly chart said and happened to also get a sequential sell, I'm sorry, a sequential -13 signal here, which is looking for downside exhaustion. Did not get stopped out. And today's a -9 count, right? 9 consecutive days that the close is less than the close from 4 bars prior. These are often short-term turning points. So I'm going to really see over the next several days if uh, XOP is trying to put in a bottom here. If it does, then and oil itself doesn't keep going down, and now natural gas is gotten plummeted and is under $2, and that's why it's, you know, this has also been dragging on the natural gas related names, this XOP um, ETF. But if this can recover, then in the future we take out these 24.5 highs. This thing can fly after the tight bottom it's put in. So even very short term, where we're trading now in the next couple of days becomes really important. So if you're looking to potentially get into you're certainly getting into a beaten down sector. If you're looking for cheap names, the whole group is relatively cheap. Obviously, you're going against the grain here by trying to bottom fish in energy, but at least you know where your stop out is at this point. You should not see new lows, and if it's gonna bottom, it should bottom very close to today's price action. So that's my thought on energy. So, you know, you can do a little bottom fishing here, but clearly this is a sector that underperforms and underperforms badly over time, which means that you would have been better in any other sector in the S&P other than energy for the last many years. The question is now whether or not in 2020 does energy get kind of a defensive bid. If the market pulls back at all, is this going to be a sector that gets a bid because of the cheap names? If the market continues flying, then energy is probably not the place. And we've already seen from what happened when the U.S.-Iran crisis that was just over the last few weeks. Oil spike, got up to 63 and change or so, but quickly came off. So even a shock to the oil system could not keep oil up for more than a day or two before sellers came in, and it's because there's massive oversupply of oil, and that's the reason why, you know, shorts get burned and they get forced down on the big news, and then it just gets sold down as it does so very frequently. The last thing I want to talk to you about is, and we've got just about a minute left, is a new piece coming first quarter this year. I'm not sure of release date because still figuring out some pieces to the puzzle. But if we go back to this chart of sector performance, think about how important it is to be in the correct sectors at the right time. And what we're going to do is come out with a new piece, a new report that you'll be able to subscribe to, that will essentially pick for you the best spider ETFs to be in at any given time. And the best and the way to outperform the market is to be in the right sectors at the right time and to avoid those that are the bad drags. So in this case, let's say materials and energy are the bad drags to start the year. So we'll tell you more about it over coming weeks, but this is going to be a very exciting new piece that I'm designing for you guys that will really help make a difference in your chances of beating the market. So that's it for this week. Hope you enjoyed the show. I'm Rick Bensignor, and this is In the Know Trader.